In today's episode, we are going to answer, do I have to pay taxes if I move into my rental property? I get this question all the time where people come and ask us, they're like, well, I've got 10 rental properties. I'm just going to move into each one for 2 years, be excluded $500,000 in capital gains, and then not pay any taxes whenever I sell the properties. So I have Andrew Kefier with CBIZ. He's going to answer this question. Andrew, can somebody do that? Move into all 10 of their rental properties 2 years at a time and not pay any taxes on the sale of their property?
Yeah, thanks for having me here, Jose Luis. And yeah, no, unfortunately the IRS has caught on to that idea, and does not allow that a full exemption. So typically what happens is the IRS has rules in place that the state also follows, that if you have a primary residence and you live in that residence 2 of the last 5 years, you can exclude up to $500,000 of gain for a married couple or $250,000 of gain for a single individual. So a lot of people were thinking, well, I've got this rental property, I've had it for 10 years or so, let me move into it for 2 years, and then if I sell it after 2 years, I should be able to exclude all that gain. Well, like I said, the IRS has caught on to this idea, and they have what they call periods of non-qualified use. And so that's the time period that you're using it as a rental property. So you can still do this, and you could take advantage of a portion of the gain, but you're not going to be able to exclude all of the gain on the sale of a rental property like this.
So when you say a portion, how does that mathematical formula work? Is there a mathematical formula, meaning like how much of the 500,000 in that example where it was, let's say it was a rental for 10 years or a rental for 8 years and a primary for 2, meaning 10 years of owning it, how would that be calculated?
Yes, if you own that property for 8 years as a rental property, moved in the last 2, you've got 8 out of total of 10 years of ownership that it was used as a rental property. So 80% of that gain would be taxable and would not be eligible for the Section 121 exclusion on the capital gains on a primary residence. So it's kind of based on a portion of the years that it was used as a rental property divided by the total number of years that you've owned the property.
Got it. So in that scenario, it's 80% of the time it was a rental property versus a primary. Right. So how would that 500,000 be calculated? Because technically I lived there for 2 out of the last 5 years, but then technically it was a rental for 8 years. So does that mean that if I'm normally excluded 500,000, that I would normally only be excluded 80% of that 500,000 or 20% of that 500,000?
Yeah, well, it actually kind of flips the other way. So you calculate your gain first. So let's say this property has let's make the math challenging, a $700,000 gain on it. Because 80% of that was non-qualified use, you're going to have to recognize and pay tax on 80% of that gain. So we take our 80% times 700,000 would be $560,000 of gain that I'm recognizing. Then that remaining 140,000 you would test as a primary residence.
And that basically 140,000 would be excluded for that 2 out of the last 5 years, basically.
Right. Yeah.
So
because you met all the other qualifications for that exclusion.
So in order for this formula to work, where you move into a rental property, you would have to live in it for longer than 2 years. Like technically, the longer you live in it. So like, let's say in that example, I move into it at year 10, or it's been a rental for 10 years, and then I move into it at year 10, then I live in it for 10 years. Now it's 50-50.
Right.
So now if there's a gain of 500,000, I'm excluded. Potentially half of that would be taxed, and then the other half would go into that exclusion.
Right. Exactly. Yeah. So it's all proportional based on how long it was rented out versus how long you lived there as your primary residence.
Got it. Okay. Have you ever had situations where somebody does that, and if somebody has done that, could the IRS come back years later to basically do an audit, or I think the escrow company only asks you if it's a primary residence and if you live there for 2 out of the last 5 years. So I don't think that the IRS catches on immediately if somebody does that. But could they come back and get you after the fact? And if so, how long do they have to get you?
Yeah, so generally the IRS statute of limitations is 3 years. There could be 6 years statute of limitations if they suspect what they consider fraud or gross negligence. And that would be underreporting your income by at least 25%. So if you have a large gain, you could be reporting or underreporting your income by 25%. So theoretically, 6 year statute of limitations. But the IRS does have records, and they would see potentially that this address was listed on your tax return for a number of years as a rental property. It was reported on Schedule E. All of a sudden, it becomes your primary residence, and that address is posted on your 1040 page 1 right underneath your name. Theoretically, they could do some matching there and see that, hey, wait a minute, this is the same property. I wonder if something's going on here.
Got it. So basically, it can lead to something. So technically, somebody could feel like they got away with it because they sold the property and they didn't pay any taxes, and they feel really smart. But technically, it could come back and bite you, is what I'm hearing. Basically, in other words.
Yeah. Yeah, the IRS can always come back and look at these transactions. And real estate transactions tend to get looked at if an individual goes through an audit, just because those tend to be higher dollar volume transactions on somebody's tax return. And so they're and they're not recurring type of things because they're the one-offs. So those types of things kind of stand out a little more than your wages or your mortgage interest or the same rental property that you're reporting year after year.
Have you ever seen it where this strategy comes back to bite somebody, and what did that end up looking like?
Knock on wood, I haven't seen it come back to bite anybody yet, because we do the allocations and report the gains appropriately based on the ownership periods of the rental use and the primary residence use.
So if somebody didn't file properly, then basically it could come back and bite somebody. But if somebody's doing it properly, where it's like this percentage of the time. So I asked this because I've asked this question to several accountants, and I've had clients that ask their own accountant, and their accountant's like, no, if you live in the property for 12 the last 5 years, you're excluded. But then I ask you, and you're like, no, this is the way that it works. So sometimes I have trouble. I'm like, okay, who's right, who's wrong?
Yeah, no, I mean, years ago in the early 2000s, this may have worked, but in 2008 is when the IRS put this law into place. Then you have to look at the time it was rented out versus your primary residence. There is something, though, that I wanted to bring up. Kind of the flip side of this can work, though, where if you do have a primary residence that had never been rented out, you bought this house and it was your primary residence, and you live there, and you decide to move out and rent the property. So let's say I've owned this property for 10 years. I decide to move out. I can rent this property then for 3 years and sell it at the end of that 3 year period and still take advantage of my full $500,000 gain because I had full primary residence use. I rented it out for 3 years. If I sell it at the end of the 3 years, I've lived in that house and used it as my primary residence 2 of the last 5 years. So that gain would still be eligible for that full $500,000 exclusion. The only thing I'd have to pick up is any depreciation I took on that property in the 3 years that it was rented out. I would have to, what the IRS calls, recapture that and basically recognize my old depreciation expenses I now have to pick up in income. But that's a strategy I've seen a number of people use, is renting out their primary residence, but you have to watch that 3 year cutoff, because as soon as you go to that year 4, day 1 of year 4, you lose that full $500,000 exemption. So if somebody's going to undertake that strategy, I recommend living there, renting it out for 2 years, because a property is probably not going to sell like that. You've got at least a 30-day escrow. You've got to find a buyer for the property. So you don't want to pass over that extra day, can totally hose you from a tax perspective. So you don't want to get too aggressive on this. You want to have some time so that you were living in that house 2 of the last 5 years.
Now, what happens if that individual goes past the 3 years of being a rental and then they move back in? Which scenario does that apply under?
That would be a time to call your CPA because you've got a mix of both situations, and there would be some of that gain that would be taxable because you have that period of what they call non-qualified use in between.
Basically. Got it. Okay. Sounds good. Anything else that we should know about this topic, Andrew?
No, I mean, it's a complex topic. Ownership, time periods of when you live in the property as your primary versus rental properties are all going to come into play when you have this situation. So this is definitely a time when you want to consult your CPA or accountant or tax preparer to help you work through this process.
Not only that, but this could change in the future, positively or negatively. So it's always recommended that you talk to your CPA, and then every situation is different. So I'd recommend talking to your CPA. So if somebody wanted to get in touch with you, Andrew, what's the best way to do that?
They can give a call to my office. The phone number there is 805 988 3222, or my email address is akefier@cbiz.com. It's AKIEFER@CBIZ.com.
And then once again, in today's episode, we covered, do I have to pay taxes if I move into my rental property? What Andrew discussed was periods of non-qualified use. So if you want to ask your accountant about that, the periods of non-qualified use. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button. Thank you again, Andrew, and I appreciate your time.